Man, how you guys doing today?
Pretty good, man. Pretty good. You know how Napoleon Hill back in the day, he would say happiness lies in the hope of future achievement?
Yeah.
You know what I'm thinking about achieving, man, that I'm pretty happy about?
What's that?
Grand T time.
I am too, actually. I've been talking to a couple people about that trip.
Yeah, that's going to be pretty fun.
But
Yep, Grand Tea Time. So we just finished like a crazy backpacking trip for my birthday. So we're going to try to do one every 6 to 7 months.
Damn, that's nice.
Yeah.
Pretty cool. Pretty cool.
So this is our macro Monday call. We just kind of give our updated views of the markets. A lot of times it's the same stuff, but you know, things change every year on out. So we just try to guide our listeners the best we can with the perspectives and knowledge that we have. So this particular call, we're going to be talking about, you know, in addition to our updated views, a hard landing versus a soft landing. JT came across some data to kind of make him sway to the other side. I'm interested to hear.
I was never on the other side. I was always in the middle, just for the record.
He's a trader. He's a trader to the soft
you were on the other side for a bit.
I never said. I said there is a probability of a soft landing, but also you can make a case for a harder landing, which is still true.
If you were on the fence, you were leaning a little bit.
I can agree with you.
Cool. So, I guess well, I don't know which one you guys want to start. I guess JT, maybe you should start.
So this is going to be worse than 2000. No, I'm just playing. But no, the basic premise is I don't at this point. There won't be a soft landing, and I'm pretty confident. Obviously, for the record, I should disclose I don't know for a fact. I don't think anyone does. If they do, please let me know. But I don't think there's going to be any soft landing at all, even though it kind of looks like we're at that point. But I think we're still in the beginning stages of the effects of monetary policy, even though they're muted, because we've went so far in that monetary policy. Those effects, they're just going to be more lagging because of the deficit. And I think we've just drawn out this bad situation more than we should. And so I believe that's going to lead to entrenched inflation, and we can get into those reasons once we actually start here. But that's like the basic premise of it. And obviously with more entrenched inflation, the Federal Reserve exists, right? And so they're going to be continually acting upon that, trying to bring that back down, which is not going to be a good thing, especially because we're here now. So that's basically the premise.
Okay. Isaac, what's your thoughts on that? Agree, disagree?
I strongly disagree. I believe it is. Jay Powell has handled this perfectly. It is so clear that we're going to have a soft landing. I just don't understand how anyone can think otherwise. But
yeah. My bad. I'll cut you off. Go ahead.
No, well, in all seriousness, so I'm going to be kind of playing devil's advocate here. I think there's a good case to be made that we will not have a soft landing, especially if you define a soft landing as bringing inflation down to 2% without any recession. That's like a pretty... that's a pretty hard goal to achieve, but I'll make the case for why that could be what we end up seeing. And this is going to be kind of like new data metrics that I've been exploring in preparation for this meeting. So, please forgive me if there's like any issues, but I've taken down all the sources that I'm going to be citing as well, so you guys can like fact check me and give me an actually if I saying anything incorrect. But and I can also then address. You made 3 points as well, like the crux of your points in the last video. And I can address those after. But I'm first going to hit on two major reasons why I think there's going to be a soft landing. And the two reasons are first that I believe that the Fed will successfully be able to bring down wages without increasing unemployment beyond 5%. As well as without increasing layoffs either, which would be a good sign for a hard landing when the layoffs spiked. And I think that the reason why they're going to do this is actually found in a study from the Federal Reserve back in 2022, where they examined something called the beverage curve. You guys know what the beverage curve is? I'm getting.
Please
Go ahead.
Please let me know what it is. I'm sure people in the audience don't know either. And if you need to share your screen, feel free as well.
I have to check my screen if anything. Do I want to share my screen? Yeah, I can share. Let me see. Hold on. I just have my notes up. What I share? I'm just going to talk.
No worries. Hey, this is my first debate ever, by the way. I was never on a debate team or anything. So I don't know like the proper procedures.
Already changing the goalpost, I see.
No.
He might throw a temper tantrum on you.
So I also want to say, I hope nobody is bothered by me vaping on stream, because I'm gonna be vaping as we talk. So it's fine. You know, some people are
bothered and jealous.
But yes, go ahead. And also next time I'm going to write down all my sources as well. But you can still fact check what I'm saying though, just for the record.
Let him cook. No, I'm just playing.
And you know what else? No, just playing.
All right. So as I was saying, so the beverage curve is basically just a way of measuring the vacancies in the market. So it's like open positions for employment and the unemployment rate. Okay. And it's named the beverage curve. The guy who figured out this curve, like his name was Beverage, figured out the 40s. And basically the curve looks something like this. For those of you on Twitter, I'm just describing what a curve looks like. But people on here, it's like this. And the curve basically has vacancies on the y-axis, unemployment on the x-axis. And it finds that as unemployment goes up, you'll have vacancies in the market like drop precipitously.
And for vacancies in what? Sorry.
Just in the open positions in the job market. So like, if there's more positions that companies need filling, that's what they call vacancies. Okay, so it's actually a good thing for the market to have more vacancies because it means that there's a lot of jobs out there.
Which is the situation we're in now with like 8 million openings or whatever.
Yeah, exactly. So the situation we're in right now, the ratio is 1.6, which implies we're somewhere on the curve, like way over to the right and up. Okay, so on the steep edge of the left on here. But we're on the steep part of the curve, okay, near like at the top. Maybe not near the top, we're pretty up there. And the idea is that there's right now a lot of vacancies in the market, but there is unemployment still fairly low. So the ratio between vacancies and unemployment stacks more on the vacancy side. So the economy is actually doing pretty good. There's like a lot of job openings and unemployment's pretty low. Now, this could be great for a soft landing because if we're on the steep part of the curve, and we bring down vacancies, unemployment might actually only go up maybe like a percent. In the study that the Fed did, they estimated that if we could bring vacancies down to around pre-pandemic levels, we could only see an increase in unemployment of 1%. Now, why does this matter? You're wondering, why do we want to bring down vacancies? This is the model that the Fed uses in order to bring down wage growth, or just wages, period. So the Fed, in order to bring down wages, they want to see a VU curve or VU ratio. We can see unemployment ratio closer to 1. Okay, so it means one vacancy for every one unemployed person. It's right now at 1.6 vacancies for every one unemployed person, which means we see wage growth. We have seen wage growth that's been, growing slower and slower. In order for the wage growth to get even slower or start going negative, which would be what the Fed wants in order to bring down inflation, they would need to see that 1-for-1 ratio. All right, which means they need to bring down vacancies or bring up unemployment. But if the curve is correct, then we need to bring down unemployment, vacancies much more than we need to bring down unemployment. So like, if you're looking at the curve, vacancies are right now at like 7%. And then we bring it down to 4.3%, which is the pre-pandemic levels. The x-axis here is only moving a little bit, and that's unemployment. So unemployment's only going up by 1%, and vacancies are coming down like 3 or 4%. And that's fine. Like that's like, the market's fine. Unemployment's still below 5%. Vacancies are down. If the model holds, then that means that wages are coming down as well. And soft landing central. We're all good.
Soft landing central.
Man, I don't know why. But both of y'all look like y'all were trying not to laugh the whole time. So I was trying not to laugh. Man, it might get weird.
No, you know how like when you want to say something, it like physically manifests in your body. And that's what was happening. Like it was hard to hold it back because I wanted to.
Yeah, well, I got this head vein too, so I always kind of look like I'm trying to get something out.
Yeah, you got a big ass head vein. I don't know if mine still shows, but anyway.
Beyonce tells me all the time. Thanks.
No, so I'm gonna put it like this, man. The labor market data over the past probably a couple of years, but for certain within the past year, has been a bunch of mumbo fucking jumbo. And I'll tell you why. So the Fed is actually achieving their goal of bringing those job openings down. We were at 10 million a few months ago, right? And so they're actually achieving that goal. But here's the problem. They are not looking at the right barometer because jobs data has been pretty much wrong every single month. And so a piece of data came out. I'm going to remember the firm next time. I'll let you guys know if I find it. But it came out that non-farm payrolls and payrolls period that were added were overshot by as much as 500,000 jobs just in like the past 12 months. And so if we were to see a 1% increase in unemployment, our unemployment sits at 3.8% right now as of last week, and that's up 0.3% in 1 month, which we haven't seen that since I think 2011 or something like that, or right before the GFC. And so people are underestimating that one increase on a month-over-month basis for one. But let's say they start achieving that goal and they add an additional 1% in unemployment. It's not going to be 1%. If we get 1%, it's going to be 4.8%. If they were to actually add that on top of the misstated job numbers, that could quickly go from 4.8 to 5.2. Now, although we never had a recession with unemployment under 5.4%, who says that can happen at 5.2%? Now, another thing is, I've been saying this for a year. The Fed wants people to lose their jobs. He gets on stage and he says, we need to see some softening in the labor market, and we have been. And the reason he's saying that at every single meeting this year is because it's not just softening. He wants to hurt the job market. The only way to get out of this situation is to cause a recession, which is led by the labor market at this point. That's literally the only way. And they've already run the risk of overshooting just due to monetary policy over the past year, which is a high probability that they overshot. And a lot of Fed governors on the board would also agree with that sentiment if they weren't private. If they weren't private. And so basically saying that we're going to have a soft landing based on him successfully softening the labor market by decreasing that spread between openings and unemployment, I'm not going to say it's horse crap, but it's more like it's not probable, just because we had so much wrong data already, and it's showing that the labor market hasn't been as strong as we thought it was this entire time. So that's my response to that. It doesn't make sense given the environment we're in. It just doesn't.
Yeah, I'm gonna have to disagree with you there.
100%.
I mean, like, I think you can
feel free to mediate, bro. I don't want to get stuck on the same topic. We got a lot to go over.
That's true. I think that you can have a marginal, error, right? Because really we're talking as a margin there.
It's not margin.
You can have a margin of like a few 100,000 jobs. And, in the grand scheme of things, it's a margin there. And I think that, we can still totally achieve the unemployment rate that we need. You say, 4.8 could be 5.2. I don't know. That's like, to me, that's like, it's like still within the range. We could easily see this occur without a recession. You even admitted a recession has only occurred in the past with an unemployment rate of 5.4. We could have 5.2. We're still below. We have to have historic recession that just, you know, and I'm a man of history, and I just think that things happen generally how things usually go.
I totally believe that extrapolation in today's age is getting much more difficult. And so I think it's actually foolish to use historic data to understand current trends. And it actually showed, we saw the most accelerated change at the beginning of the pandemic. And so this one it showed the most, where we all thought it was going to be a recession. We all thought the housing market was going to crash. We all thought the stock market would have a sustained downturn because of history. That's the only reason we thought it. Because of history, not because of what was happening, because this shit seemed to happen in the past. So we're like, okay, we know what's going to happen. Bro, people have been wrong for 3 years now. It's 2023. And it shows that extrapolation is just not the same anymore. We have too many inputting data points these days, because you got to think about it. Even within the Federal Reserve alone, I want to illustrate this picture. Think about, on a 5-year rolling basis, how many new products are invented to help backstop banks or institutions or whatever it may be. And so you have new effects coming from pretty much every point at this structure shit. And so it's much more difficult to extrapolate. And that's why it seems like, you know, sometimes I'm changing, but I make sure to let people know I'm not changing. I'm just moving with the data, because I'm not going to be a fool and try to say, well, it's going to do this, and then react inappropriately, because we're in an ever-changing world. And you said at the beginning that Jay Powell has done a good job. I actually agree with you. And you also said he knows what he's doing. Am I wrong? Did you say he knows what he's doing?
Why not? Yeah.
Okay. Yeah, he fucking doesn't. So he said it himself. We're navigating. You know what I'm talking about. We're navigating by the stars under cloudy skies.
The one-sided debate. I listened to the one-sided.
Yeah. Yeah. He doesn't know what he's doing, bro. He doesn't know what he's doing, and not because he's dumb or he's the wrong man.
So you think he's doing a good job on an accident? Is what you're saying?
No, he's doing the best he can. But I'm saying he's running out of tools. Monetary policy isn't the right tool to fight this type of inflation. I know we're going to get into that, but he's using the wrong tools. He's doing the best he can with the belt that he has. And it's not going to work in the way that he thinks is going to work. And that's why he even felt compelled to make that statement. Because if he exudes too much certainty, people expect things. But if he exudes like a hawkish personality, people will start reacting to the downside. And so by letting the world know that we are navigating through the stars, by the stars through cloudy skies, that just means data dependency. That's all that means. We have to keep monitoring the data as it comes in, because even to us, the Federal Reserve, the people who control your money, we don't know what's going to happen based on extrapolation, because things are just, they are different now. And I'm not saying that they're different and that's going to cause a bull run or a bear market, but they're just different in an objective sense. They are.
Well, let me ask you this. So Isaac, you think we're going to have a soft landing? Is it still a soft landing? Is it considered a soft landing? We get inflation down. We haven't had a recession yet, even if the recession comes after.
That's a good question.
Yeah.
That's okay.
Oh, man.
Yeah, that is very soft.
Oh, that was not a rhetorical question, by the way.
No, that was a good question.
No, that is interesting, because obviously the issue is, like, you know, is there certain externalities that remain after you brought down inflation? Like, what is the damage or the scarring you've done to the market? Yeah, I mean, like, if the Fed policies that they use to bring down inflation end up bringing down inflation, but then the residuals cause a recession. I would say it's clearly not a soft landing, because a soft landing would imply that the medicine did not cause a recession. So you would have to see inflation be brought down, and then you would have to see probably like a sustained period in which no recession occurs. And then you say, okay, this is a soft landing. It's clear that enough time has elapsed that the problems that we created did not lead to a recession. And the reason why I say time elapsed is I know that a lot of JT's reasons that he brought up in the last video are very like high time frame things like demographics, debt payments on interest. Like that's a very high time frame sort of issue. But the longer you go on and measuring, what causes a recession, it can become harder to like pinpoint exactly what it was. So like anything that we do today will definitely have some effect, but it's hard to like really pinpoint the effect that it has in 10 years from now, right? Like this one monetary policy that we did today, or we did last year. So I don't know. So like I would say a soft landing would be if there's a period of time after inflation has gone down to the target rate, a recession does not occur. We have successfully had a soft landing. If the recession happens then 5 years later, I don't know. Maybe that was from that. Maybe that was partially from that. Maybe it was from something else.
Okay. So I want to share because these are my thoughts. I think that the market is trying to. Sorry, just make sure I'm muted on Twitter. I think the powers that be are trying to keep the markets propped up until at least after election, so that people can get reelected. And a lot of people are calling for like a pivot because recession is finally, or not recession, inflation is finally starting to slow down. And people are like, oh, pivot's going to happen. And once the pivot happens, the bull market is back, even though the stock market is damn near all-time highs, the S&P. So I wanted to share my screen and just go over. I wanted to get you guys' thoughts on this chart here. And for everyone listening on Twitter, I shared the picture on Twitter as well in the comments. So this shows what happens when the Fed pivots going all the way back to 1969. And as you can see, like every time there's a pivot, so the bottom here is the federal funds rate. When they pivot and they start to drop interest rates, we see the bottom after. So they pivoted here, we saw 36% drop, 48% here, 27% here, 51% here, 58% here, 35% here. So my question for you guys is, let me get back here. My question for you guys is, like, let's say, where's inflation on the last read? 3 point something?
PC, if you're talking about, let's just use CPI to keep it simple. I think it was at 3.8 on the last one, and then 4, exactly 4 on core.
Okay, so if we're at, let's say we get to 2% by November, which at this rate, I wouldn't be surprised. Let's say we get there, and then they pivot. Do you guys think recession happens after that? Or do you think we're going to keep consolidating?
There is no pivot coming in 2023 whatsoever unless we have a recession first. There is no pivot.
I think they would print money before they pivot.
Well, printing money will still be considered a pivot when you're draining liquidity. And so I'm talking about a pivot from contractionary monetary policy to expansionary monetary policy. That would be a pivot.
I'm talking about an interest rate pivot only. Because if that's a pivot, then
there won't be a pivot. There won't be any interest rate cuts, just to focus on interest rates. There won't be any interest rate cuts at all unless we had some crazy debacle like a black swan event, Other than that, it wouldn't make any sense to go back to the zero bound or even anywhere near that when we understand. I understand. But you will be going back in the direction of the zero bound, which would start feeding risk appetites. And so that's literally the environment that got us here in the first place. And we couldn't get back to normal. So when we had a black swan event, aka COVID, we couldn't lower rates anymore. We went right back from the zero bound from 2%. And then the only option was to print money. And that's literally why we're here, because of interest rates being so low. And so we wouldn't want to make that mistake again in the short term, because you think we have a large deficit now. If we cut interest rates in half today, bro, that deficit will be, it'd be pretty insane, to be honest. Because like I said, you're feeding risk appetite. So I don't think there's going to be any pivot in 2023 at all. And that's not a new thought. You can go back and see me saying that shit since the end of last year. There won't be a pivot in 2023, 100%.
Unless something breaks, is what you're saying.
Unless something breaks.
Isaac, what's your thoughts?
Yeah, I kind of generally agree. Everything I've seen indicates that there's just no pivot on the horizon. I mean, like the main reason is because we're not out of the weeds, right? Like we still have a pretty damn high core inflation rate, which is really what the Fed is using to make their to make their models for how they want to change interest rates. And yeah, I think until it's called the shelter inflation goes down, which I believe is like 90% of all the July core inflation increase was from shelter inflation, which is housing, rent, utilities, all that sort of stuff. Until that goes down, we're not going to see a pivot. And I was looking at some Federal Reserve notes about when they expect that to happen, and they don't expect the shelter inflation to hit like around 2% until April 2024. So we're probably going to see. Yeah.
That doesn't make any sense either. So this is why you got to be careful when you're monitoring Fed data. They're literally going to tell, bro, the worst thing the Fed ever said is that they're going to be a mild recession. Think about that. We've had significantly worse events that they knew were coming, but decided to use light language. Now, of course, they don't want to scare people, but you have to read.
Wait, hold on, real quick. Are you saying you disagree with the 2%
shelter? Sorry, I'm going to get stuck on housing. Like, housing is not coming back down, which is part of the reason we're going to have exacerbated issues. Housing is not coming back down at the beginning of next year, at the end of this year, unless they spike interest rates to 10%. And shit, that won't even bring housing. Bro, housing's not coming back down unless we have more supply. And I've been saying that as well. That is the only solution. And I don't see where that supply will come from. Because if they were to offload MBSs back onto the markets at whatever rate, in addition to shadow banks getting rid of their loans, that will cause a correction that is it's a bit too much for the housing market. You can't offload all that supply that they hold on their balance sheet at one time. And so lately they haven't been moving it at all. It's just sitting there. Even though they said they were going to offload it. There is no relief coming to housing. You got people, all these smart people telling individuals that rents have been coming down. No, they've been decelerating. They're still appreciating at a pretty good pace year over year. And it's shown throughout history, because we're an inflationary society, real estate is one of the best inflation hedges. It's been shown. Rents, as well as prices, because of the 30-year mortgage, in my opinion, they follow inflation probably better than gold, damn it. And so there is no, and so there is no relief coming in the near term. I'll say within the next 3 years for housing, which would help them hit their goal of that soft landing if there was some relief. We've only seen deceleration. We haven't seen declines, except for like we declined prices like a few months ago. It was like 0.1%, but that's reversed already. So
I mean, correct me if I'm wrong, but isn't the CPI shelter inflation already coming down?
That's where it's weird, bro, because yes and no. It was still elevated. It's been decelerating, like I said, but it hasn't been declining. And so there's not going to be a relief or a deceleration enough. You would have to kind of stall the housing market in a way. And
when you say decelerating, you mean it's like declining is this. You just mean it's going up slower. Is that what you mean?
Yes.
Okay.
100%. And what was the question again, Isaac?
Well, I mean, like, I guess I'm just looking at some of the CPI shelter inflation stuff from this
spit numbers out, because at the end of the day, you know, you can look at shelter numbers on the CPI, or you can look at the housing market data. Those are painting two different pictures pretty much all the time.
Okay. And what data are you referring to?
So I'm referring to housing market data. So I'm looking at existing home sales, new home sales, home prices, I'm looking at interest rate policy. I'm looking at 30-year fixed mortgages. I'm looking at existing mortgages versus new mortgages. You know, all this data that comes in on a damn near weekly basis, it fluctuates, but it's been going in a general trend, and that's up. So even though you've seen some blips that were, you know, to the downside, it's not going backwards. It's going to keep moving forward 100%. At this point, the only thing that could fix the housing market is supply. That's it.
It looks like the CPI shelter inflation numbers have gone down from their high at 8.2% to now they're at 7.7%. It's not, I mean, that's a precipitous decline for the last 4 months, it looks like. Which granted is still very high, obviously. And there was a slight increase in July. But I mean, it's I don't know. Like I guess it's you could say you know it's not accelerating. It definitely is lower than its all-time high. And I think you could see it turn around. And I don't know. Like you're kind of just discounting completely, I guess, any like Fed study. But I don't think Fed studies are completely useless. They can be wrong.
I agree. They're not useless. I'm not discounting. Well, I would agree. I actually am discounting it. I'm not overlooking it though. Yeah.
Well, I mean, I guess. I don't know. I guess we're just indexing them differently.
Yeah. So basically, you're looking at the shelter portion of the CPI, which they include homeowners equivalent rent.
Yeah.
Okay. For those of you who don't know how that's calculated, they basically just call homeowners. This is very simplified. They basically just call homeowners and ask, hey, if you were to rent your house out right now, what would you rent it out for? And then they do that survey like periodically, and they give them that potential number. Guys, most homeowners don't know what the hell they're talking about when it comes to rental prices on their homes. It would make more sense to just ask investors. They run these numbers every day, but they don't. The shelter portion of the CPI, people talk about it all the time, and it's what is it like? It's a huge weight in the CPI. I think it's like 30% or something like that.
40%. Like 19, 30, and 40.
Yeah, so it's a huge weight. So of course they're going to put a lot of attention on it. But just the way they calculate the data, it doesn't make sense pretty much ever according to the real housing market. Because if that was the case, yeah, it doesn't make sense. Doesn't make sense. I don't want to open up a can of worms I can't swim in. So
that's I mean, like
anyways. Exactly.
Florida.
That's a good one.
Yeah, no, I mean, I agree. Like in the sense that I don't know too much on how their numbers are inaccurately calculated, so it's kind of hard for me to speak on that. I'm using the numbers simply because that's their job to provide us with these sorts of things. And I'm not saying they're 100% correct. I don't want to over-index, but I also have them, I guess, as one of my different things that I look at. Especially if I'm representing the soft landing side, and like I'm gonna use the Fed numbers, obviously.
So let me ask you this: do you think inflation is gonna be sustained at this low level, or do you see another uptick?
I know that you're in the seeing an uptick.
What do you think, though?
He camped out there, heavy.
I saw he's wavering. No, I know. Well, I remember the last video. I know I keep referencing it. It did give me a bit of a disadvantage because I know a lot of the talking points now. But I know that you said that it was basically 100% cited, like inflation is definitely going to increase.
It's a higher probability that it increased versus it doesn't. Yeah.
So what is your reasoning behind that?
Well, all right. So I have to go back to the beginning. So during the pandemic, let me put it like this. So Lynn Alden, you know who Lynn Alden is? She kind of goes over this a lot. And gosh, I just love Lynn Alden. Hey, if you ever listen to this, Lynn Alden, we need you on here, okay? Jesus. But anyway, she talks about how inflation is created in different times, right? So she goes through bank lending, and then she goes through deficit spending. So we're in a period, and I don't know if she coined this term, but I've been using it. Fiscal dominance. That's where we are right now. the inflation that we've experienced over the last few years was more fiscally driven and not driven by bank lending. And so the Federal Reserve's monetary policy is built to address bank lending. It's built to address credit creation. That's what it's built for. It's not built to address stimulus going to consumers. It's not built to address any type of fiscal policy at all. They're supposed to be separate. And so that's kind of a given, right? And so all the inflation that we pretty much, I would say 90% of the inflation that we saw over the past few years came from fiscal policy, which is why we've seen muted effects, which is why we haven't had that recession, because fiscal policy has provided that buffer or floor for markets. Because if you have monetary policy tightening bank credit, and so you have less capital for investors to put into asset markets, but on the flip side, you have the employee retention credit pumping $29 billion a month into institutions and businesses. Most of those people, they put it into assets. They're not going to buy consumer goods. Consumer goods are bought by, lower income individuals when they get that stimulus, which is why we saw food prices and gas prices and all that shit go up. But, and what was the question? I want to make sure I actually answer your question real quick. My bad.
What do you think inflation is going to go up?
Yes. So, and I would say short to medium term, by the way. So, because we have that ERC and other fiscal stimulus policies kind of providing a buffer against monetary policy, that forces monetary policy to work harder. Now, all this money that's been spent, and it's been showing, the money that has been spent from the ERC, it's going into assets, 100%. And some of those people, now that they're not, a lot of those people, they're choosing to forego being in markets because they're uncertain. And so you actually see a slight push from some of those people to buying consumer goods. And so inflation, obviously, on top of that, it'll cause more asset price inflation than we thought, which is why I'm a believer that markets have, room to run. I think September is going to be, like, if you're invested, a pretty good month for you. Even though historically it's not that great of a month, I think it's going to be a good month. And so you're going to see that. On the flip side, I'm talking about equity markets. I can't speak for crypto on that one. And in addition to that, whenever you have a deficit as high as we do, so there was actually a study. I did bring out a study. So a study by the World Bank found that countries whose debt to GDP exceeds 77% for long periods of times, they experience a significant slowdown in economic growth. And every percentage point of debt above this level costs countries 0.017 percentage points in economic growth. So our deficit is going to grow larger. And so because our interest expense is now becoming larger on our overall debt, that in itself is inflationary for the US dollar, which somehow, some way, it will leak into consumer prices. It will definitely leak into oil prices, in addition to OPEC cutting supply. And they pledge to keep that shit cut for an extended period of time. And so we're going to see an uptick in oil prices. We're going to see an uptick in our interest expense on our deficit. And, I talked about demographics last week, but that's, like you said, more long term. And yeah, man, I hope I answered your question. I kind of said a lot there.
Yeah, I don't know. I guess it's hard to pinpoint when exactly a lot of these different factors will start to play into the inflation rate. Mostly because I get the interest rates on debt repayments. It's higher in real interest money. It's higher just in total quantity of money than ever before. It's not the highest percentage that we've ever had. We've had higher percentage GDP. We've had higher in the past.
The 134 was the highest, I think, 134%. was the all-time
no,
high.
percent of GDP. I'm talking about just the interest rates as a percentage of GDP. So just the interest rate debt repayments. And I know I used another Fed study for this. So
have we had a higher interest expense than the projection of 668 billion, 2.4% of entire GDP? Have we had a higher
in percent of GDP? Yes, not in total number. The total number,
okay.
At least as long as these numbers are correct. I know the Fed can have some different numbers. I'm using this is a Federal Reserve Bank of St. Louis, and they posted this on the Fed. You guys use Fed at all?
Yeah.
Yeah. So they just posted this on Fred, but the source is from the Federal Reserve, which is just the Federal Reserve of St. Louis. But yeah, so it's their numbers, and yeah, it shows we had a higher percentage back in 2001, and we maintained a higher percentage from like 1981 up until 2001. Hit a little globe there. Then we brought it down throughout the 2000s, and now it's back up again. But obviously it's higher in just raw numbers because our GDP is a lot bigger now than it was in the past. So obviously the raw numbers are going to be higher, even the percent is less. But it's not that that's not like a big factor. It's not like that's not something that matters. It's hard for me to index that properly on like a time frame. Whether I think this is.
I agree with that though. Like, my bad. Go ahead.
No, yeah. So I mean, I think you can agree and give me whatever you're gonna say.
No, yeah, I super agree with that, and that's kind of why I haven't really been given any time frames, because once again, that would be like a foolish thing by me, right? As an investor to be like, oh, it's gonna happen here, so let me be certain. So in terms of time frames, I can give you like a general range, and that general range is probably between 1 year and 2 years. Other than that, I'm useless in that regard. I'm not a genie.
I guess
the last point I was going to make actually with inflation, I'm trying to think of it, but I didn't. I couldn't think of it at the time. So you brought up Fred, and I was looking last night on Fred at the repo market, and so the Treasury and the Fed, they've been working together obviously to refill the TGA, and I remember bringing this up probably a month ago, but they've been doing a pretty good job at pulling them out of the repo market, which is like stagnant capital for the most part. And so I don't know if that's going to continue, but let's say they decided, because that was a big debate with them. And so let's say if they decided to go ahead and pull them from bank reserves, that would actually help inflation come down more if they decided to pull them out of bank reserves, but they risk running tighten liquidity too much, pushing us down into a deep recession, just because they're pulling so much liquidity out of the market at one time. And so by them pulling refilling the TGA by pulling funds out of the repo market, and the repo market, by the way, guys, is just like an overnight lending market with banks, to keep it very simple. And so, they trade, multiple types of securities with each other overnight, and they earn, a small bit of interest on that. So if I loan Vince $100 today, for example, or I loan him my bike today, he'll bring that bike back with like a $20 interest fee on it or something like that, right? So just to paint that picture. But if they decided, this right here, by pulling it out of the repo market, it actually doesn't provide a buffer against the potential inflation that is on the horizon, which if they decided to do it on the flip side, in addition to everything else I said, that would actually help keep inflation down. But because they're pulling out of the repo market, liquidities, it's drying up in some places, but it's still flush in other places. And so by pulling it out of the repo market, it actually exacerbates the inflation issue because you don't have a buffer in the face of everything else that I mentioned previously. So that was the last point I was going to mention before.
Yeah, this kind of relates to the paper that I'm writing right now on liquidity crisis and inflation. Because the general thesis of the paper is basically that the Fed discount window and other Fed liquidity facilities in their efforts to prop up banks that are experiencing liquidity crises will end up, increasing money supply, increasing, lending, and then thus also increasing inflation, which would then counteract monetary policy that they're trying to tighten the market with. And the solution that I was exploring was the idea of using the Federal Home Loan Bank, which uses global credit markets instead. Which actually, when we ran the numbers, it seemed like we're not sure if we're going to include this though, but just because there's some other externality issues. But it seemed like it actually would have a negative effect on inflation when the Federal Home Loan Bank extended liquidity. And they're, by the way, they're the second largest liquidity extender after the Fed. And the reason why is because a lot of the banks that access, Federal Home Loan Bank liquidity access it by putting their deposits into timed deposits, which aren't counted in the monetary. Like takes it out of the monetary supply for a while because they allow people to do 30-year, and stuff like that. So I don't know. I think that's an interesting angle. I like how liquidity markets affect monetary policy and affect inflation. Because I think it's kind of an understudied field. I think there's a lot there, a lot overlapping. And yeah, I kind of agree with the Fed. Definitely is very myopic in how it approaches inflation. I think also that fiscal policy definitely has a large impact that is perhaps under indexed in how we kind of look at inflation. So yeah, that's all very interesting.
Yeah, so we kind of, Vince, you brought up this point on the last spaces on our Ray Dalio book review or book, what did we say, overview? Whatever we're going to call it. But you said basically there were 3 solutions. Was it to bring inflation down, basically?
I can bring it up right now.
Okay, perfect. It was 4. So just to say this really quick, so austerity isn't an option.
Here we go.
Go ahead.
The policies that reduce debt burdens fall under 4 broad categories. 1, austerity. 2, debt default / restructuring. 3, debt monetization / print money. 4, wealth transfer from the rich to the poor.
Right. So I kind of took those points as a proxy for me to think about inflation. And so I'm like, okay, Jay Powell definitely has to hike us into recession because austerity isn't an option. Paying off the debt isn't an option, and debt repudiation isn't an option. Like we're going to just keep the debt. We're not just going to cancel the debt with other countries, and within our country. So the only option left, if I'm just being a student of economics, is recessionary activity caused by the Fed. Because if we didn't have the Fed, we wouldn't be in this position in the first place. And so now they have to act. And the only reason I'm saying that because somebody posed an interesting question. If we didn't have a Fed, would we be in a recession? Would we already have a recession? I'm like, well, if we didn't have a Fed, we wouldn't be in this position in the first place. So not saying we don't need them, because we do, in my opinion. But I'm just stating a fact that if we didn't have them, we wouldn't be in this position. But we are. And so the Fed has to act. And the way that they will act is by hurting the labor market, because that is the only clear way of getting things back to stated goals.
Yeah, I mean, I think that's essentially all correct. The crux of the soft landing argument, though, really just comes down to what degree are you going to have to hurt the labor market in a sense of unemployment, and to what degree are you going to affect job openings. And that argument really relies heavily on the idea of wages being a large part of, I guess, the long-term effects on real inflation or core inflation. I think that if you look at that, again, it's like one of these things where you can get into the weeds on it. We can look at the study, we can look at the numbers. The numbers are, have a certain degree of error that then affects what the outcome is. I mean, even the study that I was looking at, there is a huge factor that they look at that is simply the matching rate. So like the rate at which the jobs in the market match people who are employed when it comes to skills. And the matching rate, if you change it just by a tiny bit, it completely changes the outcome on how the curve is affected, right? So the curve becomes much more straight if it makes it so that the job matching is harder. And with the straighter curve, you have to bring down like inflation or unemployment is way further up than with the concurrent decrease in vacancies, which would mean a recession because you get like an unemployment that's close to like 6 or 7%. which is definitely a recession. So yeah, I mean, like, there's a lot of factors involved. I don't think Powell's wrong when he says that. What is it? He's guiding a ship at night or something.
Yeah. But I agree with that. Like he said the right thing for sure.
He said that too.
No. He just it was navigating by the stars under cloudy skies.
He is coming with the mystical.
That was Vince. We were in the forest, man. You kept using those metaphors, bro.
Yeah. Jay Powell's getting really philosophical recently.
I like Jay Powell, man. I really do. I think he's one of the most transparent. Obviously, I think at this point it's pretty objective. The most transparent Federal Reserve Chairman we've ever had, but also the most prudent. Because this is a difficult environment. And by the way, it's not like guys, you can make a case for both, and I keep saying that. I can easily sit here and make a case for a soft landing. But like I said before, given the current environment we are in today, not last week, today, it just doesn't make sense that we're going to get a soft landing at this point. Because to me, that's saying that we've got like 80% of monetary policy built into markets right now. That's not true. 100%. I can't give you that percentage, but that's not true. That most of it's built in or priced in already. And so I don't know. I think it's prudent to just keep monitoring the data yourself. Don't be too convicted. I mean, if the guy's running your monetary system saying that he's basically flying in space, not knowing what the hell is going on.
Is that the newest one? It's always different with Jay Powell. It's always a different one.
Flying in space, ship at night,
cloudy skies. It's always something with this guy.
Yeah, the lags will catch up. There needs to be some type of like reconciliation in markets. They will catch up. It just has to work that way, or else you're telling me everything's broken and being an investor will be damn near impossible. Making models will be a thing of the past, and it just doesn't work that way. And I actually meant to say this as well. Sorry, I'm kind of going backwards. I meant to say this about studies. I was actually reading one study. I think it was about the IMF. So they basically came out with a study trying to argue that gas and oil prices have like a very minimal effect on inflation. You agree with that?
The gas and oil prices? What are they talking about?
It has a minimal effect. If I can remember the crux of the argument, it was like basically, just to throw out some numbers. So let's say if historically we thought that gas prices and oil markets caused higher interest inflation by the tune of like 70%. They're basically saying it doesn't have an effect, and that effect is like null at like 0.60%.
They're referring to inflation that does like measure energy as well. I'm gonna find it. I haven't heard that before.
I'm gonna find it and send it to you guys. So my point in that was, be careful of what studies you're reading. God damn it, okay? Because obviously, gas prices and oil prices play a huge role in inflation. And so that's why even when I read a study, it's like, I'm not trying to disprove it. I don't know. The best way to say it is like, I'm always looking at it in an objective sense, like without my bias as much as possible. Although that's damn near impossible to look at things without bias. But yeah.
Yeah, I mean, I agree. Like studies generally are not the best. I mean, even our boy Powell, he understands that. So
yeah, he was saying driving a car blindfolded is what they're doing.
Yeah, I heard that.
Oh man.
I was actually trying to think of one too. So
I'm like, I gotta throw one in there too.
Yeah,
fuck. I'm sorry. Look, I can't forget this, bro. I feel like we're coming to an end. I can't forget this. Commercial real estate. It's the the huge elephant in the room. I think people are like starting to ignore it a bit because we live in 2023. So like drama happens in waves, right? We care about it for a week and it moves on. And it's the same thing in financial markets. And so commercial real estate, you got $4 trillion due in the next couple of years, right? Next 2-3 years. Once again, just to keep it very simple, you've got office building operators having their occupancy cut in half. Excuse me. You have their occupancy cut in half. You have the cost of debt that they haven't taken on yet. The cost of debt rising. They're still making their payments with like half vacancies or half occupancies. And rates are going to be higher when those loans mature. And so now they're in a position to where they're going to have to do something about it. A lot of people will refi stupidly. They won't sell and take the loss. A lot of people will refi. And so they're going to be paying, a lot of people are going to be paying 4 to 5 percentage points more on the cost of their debt while their occupancy rate is sitting at 40%. And they won't even be able to afford their debt service. And a lot of them are modeling that, but they're still going to carry through with it, which people are weird. They're still going to go through with it. And so how's that going to play into the overall economy when you have one of the foundations of America, real estate, commercial real estate, American enterprise, going through one of the most tumultuous times probably in the last 50 years? I think people are underestimating that, 100%.
Yeah. I think you're probably right.
Damn it! Come on, I thought you were gonna give me something.
I don't have much on. That's not my area of expertise. I can I'll go over like some of these big things, but I don't know. I can pretend I know stuff, but I don't know. It's probably unethical.
No, it's not much. Honestly, it's not much anyone can say about that one, though. To be honest, it's like if anybody tried to argue with me on that point alone, okay, yeah, you're just one of those. There's a joke, an Einstein joke. I actually heard it last night, right? So he said, Einstein goes to heaven, right? And a guy walks up to him. He says, "Oh, Einstein, nice to meet you, you know." And Einstein stops him. He says, sorry about my son crying, by the way. He says, "What's your IQ?" He says, 140. He said, "Okay, perfect. We could talk about physics, string theory, theory of relativity." Next person comes up. He says, "What's your IQ?" He said, 130. "Okay, nice. We can talk about philosophy. We can talk about life, blah, blah, blah." Another guy comes up. "What's your IQ?" 120. "Okay, we can talk about financial markets. We can talk about bonds, stocks." Last guy comes up. "What's your IQ?" He said, 100. He said, "Oh, nice. We can talk about culture wars."
Wait, what?
He said, "We could talk about culture wars."
Yeah, but don't you dare bring up philosophy and,
Bro, I swear, and that's literally like most people in America these days. If anybody tried to argue with me on that point, that's the type of person they are. The person who thrives in culture war conversations.
I'm glad it is.
That's a interesting joke.
Bro, I don't know why that shit had me dying last night. I'm like, man, he's smart. All right, sorry guys, I'm gonna go on mute. I don't know if you can hear that pretty well or not.
It's okay.
It's okay.
It's not. I mean, it's not
too bad.
It's certainly not a problem.
Okay, because it's really loud to overhear, so I don't know how well it's coming through.
It's not that bad.
It's
not louder than
our voice. It's fine.
Yeah, that's my 13-year-old son crying. That's like, no, he's 2 years old.
Bro, for a second.
It's my 45-year-old son
crying like a baby. But yeah, man, no, I appreciate it, Isaac, because I know, like I said, we both can make points for pretty much both scenarios. So I appreciate the challenge because you did bring up some great points.
Yeah, I mean, mine relied pretty heavily on the curve there. But which I thought would be new information for you guys. I thought might be interesting to throw out.
What's curve? The beverage curve?
Beverage curve, yeah.
What a shitty name by that guy,
let's be honest.
Beverage? I mean, my last name's Shish, so I can't really.
Wait, is this his last? Shick's pretty cool, man.
Shish? Are you kidding?
Sounds like a agent shit.
Sounds like a spy, like a fucking assassin. That's actually pretty badass.
That's true.
All right.
Beverage, like,
oh,
you
you gonna drink me? Like, well, that was gay, first off.
Hey, you couldn't use the G word, bro. Jesus.
It's the same
Yeah,
thing,
use the J
bro.
word.
It's fine.
It's the same thing.
I'll
But
edit
yes,
that
yes,
part
yes.
out.
So no, guys, yeah, no recession. I mean, Jesus Christ. No.
Wow.
And
No
he flipped,
soft landing.
and he's back.
No 2008 recession. But I actually think Jay Powell got it right, bro. Back in June, he said we're going to be in a mild recession, which I will put a rolling recession in the same category as a mild recession, and I think that's what we're going to experience.
Yeah, I mean, I can see it. I'm generally of the camp that we get a mild recession. If we get a recession, it's going to be a mild one. Realistically, I think that's what we'll probably see. I'm definitely not also in the doom and gloom camp, at least until his demographic numbers and interest rates catch up with us.
Do you guys think that?
Huh?
I was gonna say, do you guys think that this is the case because it's so much more fucked up everywhere else? Like if the pandemic only happened in America and like only printed all this money and did all this stuff, it would be for sure. But since it's so fucked everywhere else, people want to hold dollars.
Being the reserve currency definitely has a lot to do with it, but I wouldn't say that stopped us from going into a recession.
No, it's but it's the reason why,
right now.
Huh?
Let me see.
Like the DXY, that's the strength of the dollar.
Oh yeah, I haven't checked that.
I haven't checked it.
I know that we're at like an all-time high, or like pretty damn close to in 2022. I mean, we're still doing decent. I mean, I kind of agree. I think that we're the reserve currency. We're the strong dollar. Everybody else has worse inflation than us. I mean, the fact that we're the global reserve currency is always going to prop us up to some degree. So, you know.
Yeah, we'll see what happens with Japan. They're in an interesting spot with their monetary policy shifts. Technically,
didn't the Hong Kong dollar just break peg too? It's breaking everywhere.
Oh man, speaking of CRE and China and all these foreign markets, so here's a funny story. Country Garden, which is like one of the largest commercial real estate companies over there, it was like big news yesterday that they made a coupon payment. Now they owe $187 billion, guys. The coupon payment was $600,000.
Oh my god!
So I'm thinking like, wait, how is this any good news at all?
When was the last time they made a payment? Maybe
I'm not sure, to be honest. But no matter how you slice it, bro, even if they haven't made a payment in a year, that's like if I owe $187,000, that's like me paying $60 to someone. Like, bro, come on, just wait. And
dropping a butt. Yeah.
And so I don't know. This is a funny story. So they're in a bad environment, but they're also communist / capitalist. So I guess we'll see how that plays out. I don't know how they're going to do things, even though Xi Jinping or whatever, he's been pledging to open markets more, making a more free market, but they're not there yet. So I guess we'll see.
Well, I know they have pretty massive dollar reserves as well, which they use to manipulate their currency.
Yeah.
I think they're also buying a ton of gold too. I believe they've been really stocking up on gold as well. I mean, out of the Chinese market's interesting. It's very different than ours because they also don't allow for capital outflow. Like citizens can't freely exchange the yuan. Yuan, I believe it's pronounced.
Yeah, I think it's yuan.
Yeah. So they can't freely exchange that for other currencies because they don't want everyone leaving the country. It was actually sick because it's not sick because it's good, but it's a really sick strategy in the modern era for capturing a tax base. Because the biggest issue that third world countries always have is brain drain. As soon as they start developing a bit, the top, IQ bracket of society leaves to the Western world. They're trying to just prevents capital outflow, traps everybody there. They still have outflow of billionaires and stuff, but it's not nearly as bad as it would have been if they didn't have those types of restrictions.
It's also worth
I never thought about that.
Their population is super declining because you only have one baby over there too. So
yeah, a lot of people though. It's a good baseline.
Interesting. Yeah, man. That makes me think. I don't want to keep jumping around here, but that's an interesting point. That they get worried about their total tax receipts at the end of the year, based on their growth, basically. So if they're growing, they're worried their tax receipts will be less. which is also a similar problem that we could run into if we were to continue to tighten liquidity and we still have inflationary asset prices. We'll generate less tax receipts, which means we're going to have to finance our deficit some other way, which could lead to inflation as well. So we're almost in that boat, but for different reasons. So that's an interesting point, man. I'm glad you brought that up, actually.
Thank you.
Well, real quick before we
jump
out of here. So the SEC was supposed to respond to like 6 different ETF applications. Of course, they said, fuck you guys, we're going to wait until the absolute last second. Still haven't heard anything back from BlackRock. I'm hearing people say, oh, next 4 months, da-da-da-da. If I pull up my Bitcoin chart here, give me a second. I think that well, you know, the stock market is damn near all-time highs, like we talked about, like all of the major indexes. Apple is fucking silent. Sorry, guys. Give me a second here.
Dang, San Francisco turned into the hood, man.
Apple is still at all-time highs, buying back their stock. So it's like, man, what I think is that I just don't think, like we talked about this on the Spaces with Opulus JT last week at fucking 6 a.m. I just don't think the demand is there. Like, I don't know what better news we could get. Like even XRP went in their case the other day. All those games went away. Grayscale just won their lawsuit against the SEC. Bitcoin pumped for a minute, and now we're back down. People keep talking about ETF. Like, we could buy. Institutions can buy Grayscale Bitcoin Trust. The discount went from like in the 30s or 40s, and now it's still a 20% discount. You can still buy Bitcoin at a 20% discount. People can still buy MicroStrategies. I just don't think the demand is there. Even with the halving, obviously the halving becoming less and less relevant. You know, every cycle. So I think that we probably chop around from this 20 to 30K level. Until further notice, at least until election. Who knows? Also, September is the worst month for Bitcoin every year. So yeah, those are my thoughts.
So is there a question like what are our thoughts on that?
I just wanted to give like a little crypto update since this is like, you know, crypto challenge. I don't know if you guys had anything on that. This is my updated views. I don't think the demand is there right now. Even though people are building out all these projects, ETFs. Not to say if BlackRock ETF gets accepted, shit won't like get crazy for a little bit, but even still,
so you don't think the demand is there for a spot ETF is what you're saying?
I don't think the demand is there for Bitcoin period right now. Yeah. The demand is definitely there for an ETF because people want it there, but I just don't think the demand is there for Bitcoin, because if it was, we would see a little more stuff. There are other options.
I just gotta know if he was about to jump in that. No? Yeah, so I agree. I agree. There's not much demand right now, but once again, that's based on uncertainty and liquidity. We just don't have as much liquidity as it's all base effects. We don't have as much liquidity as we did a year and a half ago, you know. So, I mean, that's going to be sustained for quite some time. I think all that definitely changes if a spot ETF gets approved. A lot of people think it's going to happen by the fall. Super not going to happen. If it does, Jesus Christ, I think I wrote a tweet like, if it does happen, I'll delete this post and pretend I never said it.
I saw that.
Yeah. Actually,
I screenshotted it. You son of a bitch, so I won't post it.
No, I actually won't delete it, but it's I just don't think it's going to happen by the fall at all. Now there's really no basis for that, to be honest. It's just one of those things like there's just not enough information out there to tell me that an ETF is about to get approved by the fall. Even though they have their surveillance agreements, they have the custodian agreements, they have kind of everything the SEC wants. It's just more of something on their end, right, that they need to figure out. So
does anyone know when the deadline is?
No. Is it October? Somewhere in October?
I don't think it
it
does.
does.
I think it's somewhere in October, and I think that's why people are saying it. I think it's like October 14th or something. I know I'm wrong on the date. If I'm not, I'll be surprised. But I know it's coming in the fall. And I think that's why people are expecting an ETF to be approved by the fall. But
I wouldn't be surprised.
Oh,
man.
you're muted on Twitter, bro.
Oh, am I? Oh, geez.
I wouldn't be surprised if it got accepted in October just because of the election time. But also would be surprised if it wasn't.
So if you get it, I don't know. I don't think it would also be a good time. It's almost like you want to approve the ETF when we for sure have recessionary activity.
Anything
I think if we get an ETF during a time like this, we're still at a point where a good enough piece of news will cause like an uptick in interest in crypto and Bitcoin. And you can actually see retail investors get hurt just because of the ETF approval.
Hurt in what way?
Like the way they're always hurt, buying at the wrong times, being too over leveraged, or whatever it may be. And so it almost makes more sense to like approve it when we are in a downtime and there's more uncertainty. So that way you get people kind of thinking in a bit more logical fashion. So as opposed to paying their mortgage fully, or as opposed to buying Bitcoin, they'll pay their mortgage. Because in good times, people do super irrational shit to buy the hot asset. And that's how people usually get hurt.
Yeah, that's true.
Isaac,
you doing anything in crypto these days? Or are you just completely out of it?
I'm kind of out of it right now. I mean, as the market cap has dropped like significantly, there's just not as much interest in it on a policy front. All the interest is kind of in things that aren't legislator related, so like stuff regarding like the SEC and whatnot. And even then, like legislatures don't have that much of an interest in it. My expectation is that once the market cap like comes back up, and you see a lot more funding going into the digital chamber of commerce, and you have a lot more funding going into like CoinDesk and all these other like kind of not officially lobbying groups, but these groups in DC that exact influence. You'll see a lot more people paying attention again, and then I'll probably start writing about it a bunch more and attending events and stuff. But I mean, people talk about it. Yeah, go on.
Is CoinDesk like tied in DC? I didn't know they had ties like that.
They have
a Binance entity?
I think so.
Or is that Cointelegraph?
I could double check. Digital Chamber of Commerce is the main one that we see around. They're like explicitly, a DC kind of. Well, they're not. I guess. I think maybe they are DC. They have a lot of DC events, like pretty constantly. And then other groups that do DC stuff are. Trying to remember. They haven't really had a lot of relevance recently, though. Just because they get funding usually from groups that are really highly in the crypto space, and when the crypto market's doing this or this, they don't get funding, and then they don't do a lot. They don't have events. They don't have as much full-time staff. So they're kind of in a lull right now because the market cap is very low.
That's so crazy, man. San Francisco really is a different place, man. I got 3 crypto events today that's happening, and every day.
Yeah. Well, policymakers are slow, just generally too. Like they're always slow to the punch, you know.
So I'm sorry, I don't know how short we are on time here. If you guys want to hop off here in a sec, but I've been thinking about something pretty heavily because I've been helping this guy. I'm not gonna say his name. No, don't say his name. I'm not gonna say his name, so we'll just cut that part out. I've been helping this guy, building a stable coin, but I'm only helping him. I don't want to be involved in the project. So I'm only helping him with like the high level aspect. So like even some terminology or just getting the system itself, the way it works from a mechanical standpoint to make sense. And, he's focused on building an algorithmic stablecoin. Now he doesn't have like institutional backing or anything like that. And so my question is, do you guys believe that there's like space and there's going to be space for an individual to create a stable coin specifically anymore? Or do you believe that that's more of an institutional play in the crypto space these days? I believe the latter, by the way.
The latter for sure.
Yeah. No, I believe it. I think that we've gotten past our .com bubble, and a lot of these kind of like independent projects, unless they have institutional backing, are going to get really drowned out, especially when the regulatory stuff starts to hit. Because when the regulatory stuff starts to hit, everything that's not in the system will be made illegal. That's just
it's like the whole greenback thing, like that we talked about.
Yeah, exactly.
That and like bro, I remember hopping off a cruise. Why does it seem like every time I go on a vacation and come back, something crazy happens to crypto? Like I got back from the cruise and opened up my fucking, my shit. Coinbase, or not Coinbase, USDC had me pegged. And I'm just like, what the fuck?
Yeah.
So, like, bro, ever since that happened, like, all the communities I'm in, like, bro, people don't touch anything other than Tether, DAI, and USDC. Like, Praxxas, all these other algorithmic stablecoins that, to be honest, have good like ways that they work and methodologies and all that stuff. Like, bro, people don't touch it no more. So
That's what I thought. Okay.
Yeah, I think it's I think it's just I wouldn't.
It's kind of pointless to try. Okay, I've been thinking that just because you might have some people who listen to this, they may want to start a stable coin. Don't waste your time, folks, unless your father is Ken Griffith. And also, yeah, it's I agree with you in that once the regulatory framework has clarity, bro, I'm not trying to go to jail or just get like a cease and desist after all that hard work.
Yeah, the Tornado Cash guys got arrested not long ago. And all they did was build software that the bad stuff.
Yeah, that's the crux of it. It's like there's an anonymity aspect to it, because I know that the main framing that politicians use to attack crypto is illicit use. So like the more like anonymous or easily, what do they call it? Like if you can use like wash trading, it's highly anonymous. If you can do other things that allow you to launder with it, that's like the first shit to go. What they want is an institution that holds real dollars that then they back their stable coin with, and then they want those real dollars to be able to be checked on by federal institutions. That's how they want it done. They don't want algo coins. They don't want anything that's too anonymous. They want stuff that's easily account driven. Because there's two models: account driven and
able to be controlled too.
Yeah, essentially.
Like USDC, they can't like do what the PayPal stablecoin is doing, like take your money, but they can like blacklist you for certain things. And even like Coinbase is saying, like they can control who uses the bridge, and they can kick you off the chain. They can ban your wallet address. The bridge part is an issue because there's going to be other bridges. But the one thing I'll say about a stablecoin, like there may be a small window for like an innovative stablecoin to come out. And the best case scenario I can see is that it has some kind of process that backs it with other stablecoins. But that's about it.
No, my argument for that, somebody actually brought that up to me. Why don't you just back it with like other currencies, essentially? And to me, whenever you have such a complex system, it actually is counterintuitive to your growth. And so it's hard to understand. People don't like complexity in systems like that because it breeds too many interdependencies and so you can miss, by definition, complex means that there are a bunch of interdependencies. And so you could miss a bunch of crucial information because of their complexity, which is why the biggest stable coins, for example, it isn't MakerDAO, for example. It's not MakerDAO. MakerDAO is big within the space, but in the grand scheme of things, it's never going to be what a USDC is because of how complex it is. And some people would argue that their model is better than USDC. But does that really matter when it comes to our government and the way they want to do things? It doesn't.
I agree.
I agree. I would add on top of that, the biggest thing that I think is occurring now is the shift from a ideologically driven like technological space that has a lot of great technology, a lot of really great systems. MakerDAO is amazing. I like that they're able to solve all these like financial problems with interesting code. But a lot of it's also very ideologically driven. You know, it's the idea of like, you want, like, Bitcoin manifesto. Like, it's all about like, we want to create like an anarcho, free society where there's no banks, and we're on banks, we can, transact peer-to-peer. The issue with that is that that's just not what is ever going to be allowed to exist. And there's some issues with that too. Like, there is some efficiency problems when you have so many different validators on the network. There's a lot of costs involved with all these validators on the network that are passed down on the person doing the transaction. And you get rid of a lot of these inefficiencies by just having like one validator or like a small, like a closed system, right? Where it's like a few validators, it's not open. Like, not anybody can join. And it's run by like a bank trust, but they're able to like create a bunch of efficiencies. The biggest drawback with crypto has always been it's had a lot of inefficiencies with transactions. It's good with large transactions that are done overseas because you get rid of like a lot of different fees and costs associated with like overseas wirings. But anything other than that, like, you don't use it for like a single transaction. There's a lot of inefficiency with that. And the trade-off with making more efficiency is you make it more closed, which then is counter to the ideology of crypto, which is an open financial system.
100% agree with that, actually. I feel like we've been making that argument too since like 2017. Because I know you guys aren't in the camp that Bitcoin could replace the US dollar as the reserve currency. I know you aren't in that camp. And that is like pretty much like the crux of the argument. So I agree with that 100%, actually. One day we'll have somebody to debate that believes that. Still a lot of people that believe that. And I would love to like get my points together in a more succinct way and debate them. Because now that I've done this, I'm like, I need to work on some shit.
Yeah, it's like saying real estate's going to replace oil. It's like apples and oranges.
100%.
Cool, man. Well, this is a great space, guys. I'll send you guys recording so you guys can do what you want with it. But yeah, thanks everybody for tuning in. Send us questions if you have it. Let us know if you guys want us to cover something else specifically. And we hope to hear from you guys on the next episode. But until then, peace.
Echo, appreciate you guys.
Yeah, appreciate it, guys.
All right, late.